All right, so I've been getting some. I got a comment today asking if I could do a new video on Silvergate Capital because Silvergate Capital has recently ballooned, and I'll jump to the stock price. The first time I did the video on Silvergate Capital, it was trading much lower than this. I'll tell you that much. So for the year, it's been on nothing but an upward streak, and it's only recently been just exploding with growth. So the company expanded from a PE way lower than this to PE of almost 50. So I think someone might be buying a big stake in Silvergate Capital, but I do not know. I don't even know where to begin trying to figure that information out, to be quite honest, but it has experienced tremendous growth in the past few weeks. And I mean, that could be equated to a bunch of things. You know, it's being caught in the fervor of this weird market that we're in, and so on and so forth. However, it does raise questions about what's going on with Silvergate Capital. So this is a follow up to the first video I did on their 10K. This is their most recent Q3, third quarter 10Q, most recently filed last month. So right out the gate, just to refresh, they are a bank holding company incorporated in Maryland, located in La Jolla, California. Currently, as of November 3rd, 2020, they don't really have a whole lot of shares outstanding, 18.6 million shares of Class A voting common stock and 64,000 odd shares of Class B non-voting common stock. So let's skip to some of the balance sheet information. As you can see here, cash ballooned, cash and cash equivalents ballooned for the year. Compared here from 2019 to September 30th, 2020, increased precipitously. Loans held for sale increased a massive amount, from 375.9 thousand to 665.8 thousand. Securities available for sale at fair value ballooned as well, 897.7 thousand to 944.1 thousand. These are massive growth numbers here. And when you're analyzing a company, you do want to keep track of how their balance sheet is growing, and especially with banks right now. All banks are cheap right now, but you need to know in what way they're cheap and how they're positioning themselves for the future. Silvergate Capital is growing their assets very, very quickly. Now, this could be a good thing or not. In the video, I'll just show you what I found. I'll make no claims on whether I'm bullish or bearish on this bank, but this is just to show you what I found reading this. Their loans held for investment have increased dramatically. Same with their federal home loan and reserve bank stock. You see here a sharp drop in OREO, but this is what you do want to see for a bank. Low OREO, other real estate owned, because banks are not landlords in the sense that they want to actively maintain houses that they foreclosed on. They want to get that off their books, and they don't want to deal with it because by law they do have to maintain those houses that they own. So the problem now becomes, how do you get houses off your books? Well, in this case, they figured it out. The bank has been lowering all the other real estate that they own, and you do want to see that drop for a bank. You don't want to see that bloat too much. Their derivative assets have increased precipitously as well, from 23.4 thousand to 34.1 thousand in the years reflected here. Now, other assets have grown precipitously as well. Their asset side is increasing very, very quickly, which you do want to see. Deposits have increased a large amount. Their non-interest bearing demand accounts, their non-interest bearing deposits have grown a massive amount. And if you had watched the last video, you will know that they put their Bitcoin deposits, their crypto assets that they accept from customers, into their non-interest bearing demand accounts. And you can see here it's blown up precipitously for the 9 months. And their interest-bearing accounts have actually dropped a very, very large amount. And that's good for a bank because they want to have a higher non-interest-bearing demand side than interest-bearing side, so that they can take this non-interest amount and make loans with it. So they don't pay you for the money. You get the safety of a bank holding your money, and they can take that money that you give them and fashion it into loans, debt that they sell to customers. This is very good for a bank, that they have higher non-interest-bearing demand accounts by a large, large margin here. Their interest-bearing accounts are almost insignificant by comparison. Now, we still got to continue on and continue reading the rest of the 10Q. You'll notice that they have no notes payable, nothing there. Subordinated debentures have actually increased a tiny, tiny amount. Accrued expenses have increased precipitously as well. Retained earnings increasing very, very large, 92.3K to 109.2K, and book value has increased precipitously. Shareholders' equity has increased a lot as well, from 231 to 283 for the time reflected in this 10Q. You'll see that their loans have dropped a little bit. They haven't made that much money off of their loans. Taxable securities haven't made too much on that. Their tax-exempt securities have grown. That is new from 2019 to 2020. And their interest-earning assets and dividends have dropped, and their total interest income has dropped as a reflection of that. So they aren't making that much on the bank side of things. Banks haven't been making that much money because of low interest rates, and so this should not be too much of a surprise. Now, however, their interest expenses have increased. No, looking at the wrong line. Sorry about that. Their total interest expense for the past 9 months has actually decreased, as you can see here, 2.9, dropping to 379. Their interest expense for deposits tanked. As you saw above, interest-bearing deposits has tanked precipitously, so they're not paying too much for their funds. Their cost of funds has dropped. Their Federal Home Loan Bank advances dropped. Notes payable, there are no notes payable this year, as you can see here. And subordinated debentures have dropped as well, so their interest expense dropped. Net interest income rose a little bit because of the drop in interest expense. This is the bank's equivalent of operating income. If you were a non-financial firm, you would call net interest income operating income. So you see a rise of it here for the 3 months ended. For the 9 months ended, it fell. Not to worry, though. This bank still seems to be very, very healthy. Non-interest income has increased. Mortgage warehouse fees increased a large amount. Deposit-related fees increased very, very large. And you can calculate out here as a percentage. I'll just do the math really quick. Deposit-related fees are 83% of their total non-interest income. It's a very, very large chunk. And you do want to know these kinds of apportionments for how they make their money. Non-interest expense, salaries and employee benefits increased. I imagine that might be because of COVID and so on and so forth. Communications and data processing has increased as well. Professional services, that's increased in their non-interest expense side. Correspondent bank charges has increased. Federal deposit insurance has increased. Other loan expenses increased. OREO expenses has decreased. But their total non-interest expense has grown very, very quickly as well. Their net income being 7.06 7 million, and diluted earnings per share at 37 cents. Okay, so this is not, nothing too crazy here, to be quite honest. It's really just bread and butter banking, so to speak. So in my last video, I did mention that Silvergate Capital, outside of their Bitcoin bank operations, they do bread and butter banking. It's typically, giving home loans, commercial loans to businesses, and doing commercial real estate, residential real estate, and a little bit of mortgage warehouse operations on the side as well. So it's nothing too fancy, but this big distinguisher is that they do have the Silvergate Exchange Network. Here they mention typical accounting things. Recently issued accounting pronouncements not yet effective. Here they mention CECL, so they are very, very well capitalized against credit losses because CECL is a bit over conservative for banks. Not necessarily a bad thing in this case, but it leaves them very, very well capitalized for steep downturns. Now, what is fascinating here on page 10, you will see government agency CMOs ballooned. The amortized cost being $212,000, increasing very, very precipitously. Now, they also own a lot of government-sponsored student loans. It's 2020. Up here is 2020, down here is 2019. Now, I hate this format. Their total available for sale securities increased from 897.7 thousand to 944,000, and a lot of it is government agency collateralized mortgage obligations. Not all of it, but it was interesting to see this massive amount of it being government agency CMOs. They did add in municipal bonds into their 2020 available for sale securities. They are not in their 2019, so that is new. Tax exempt and taxable municipal bond holdings make up some of their available for sale security portfolio. I'm going to keep moving down. They do mention here, as of September 30th, they had 31 securities whose estimated fair value did drop 1.74% from the company's amortized cost. They had 33 securities whose estimated fair value declined 1.72%. Market liquidity concerns associated with COVID improved in the third quarter of 2020. There were no sales or calls of available for sale securities for the 3 months ended September 30th, 2020, and they received $216.4 million in proceeds and recognized a $4.7 million gain and $0.9 million loss on sales of available for sale securities. So they're making money in this market too. This is nothing really new, but with this, you do have to recognize that some of this could be a one-time gain. They're not going to be making, $4.7 million gains on available for sale securities all the time, every single year. Banks and companies make money like this all the time in the markets. However, this bull market does help them a good bit. So you have to recognize that some of this extra money that they're making on their trading operations isn't always going to be there. You do have to recognize that going in and taper your expectations accordingly to that. Now, here's their real estate loan portfolio, very important for a bank, especially in this case, in this economic circumstances that we're in with COVID-19 still being the norm and still messing with real estate. Their large holdings are for 1 to 4 family, and commercial real estate is a huge chunk of their loan portfolio. Now, they show here that the consumer and other loan section of their loan portfolio has increased a large amount from $122,000 to $5.59 thousand dollars in thousands, to be a little pedantic about it. So their mortgage warehousing operations also grew from 39 million. Let me speak in more precise terms: 39.2 million to 94.68 million. Their mortgage warehousing has ballooned a lot, so their gross loans has increased precipitously as well to reflect that. So their gross loans grew from 668 million to 739.7 million. This is where the asset expansion shows up. Now you will see here the details. Their loan portfolio, their company's loan portfolio, collateralized by various forms of real estate. A significant percentage of such loans are collateralized by properties in California because they're predominantly located in California and Arizona, with no other state greater than 5%. And accrued interest on loans held for investment, totaling approximately $2.7 million for September 30th, 2020. So their allowance for loan losses, and you do want to pay a lot of attention to this. For September 30th, 2020, their total allowance for loan losses was $6.8 million. The ratio of allowance for loan losses to gross loans was 0.91%. So with this section, I do have to be a little careful because I recognize that me reading like this is not exactly the best, not exactly the easiest thing for the eyes. So you can see here 3 months ended September 30th, 2019, 2020. 3 months ended, 9 months ended underneath. So you can see here in September 30th, 2019, 6.19 million for their loan loss. Their allowance for loan losses has grown to 6.76 million. And you can see that they've actually been dropping reserves from 1 to 4 family here to here. They've taken out, and you can see, and I will show it to the best of my ability, provision for loan losses was 282 million here for 1 to 4 family in 2019, and they took out 83 million in 2020. I believe I'm understanding this correctly. If I do not understand this correctly, please let me know in the comments, critique properly and accordingly, and I will correct that. If I'm understanding this improperly, the way that I'm seeing this, and once again, I could be wrong, is that they took out 83 million in loan loss provision for loan losses in 1 to 4 family. So it does raise the question: do they believe this to be safe, a much safer thing now than it was before? Are they feeling that confident in 1 to 4 family loans that they can lower their loan loss reserves for it? I don't know. You see the same thing for commercial real estate here at negative 970,000 to 970 million to 18 million. And you can see here the growth from the 3 months ended 2019, 6.19 million to 6.73 million. Now, they did grow their loan loss reserves for construction at a very large amount, 96,000 to 1.3 million, and commercial and industrial from 312,000 to 777,000. They grew it for reverse mortgages, 37,000 to 41,000, and 250,000 to 413,000 for mortgage warehousing. So they are putting money away in the business segment of things. Whatever they're seeing in the business side of their loan portfolio, it might not be good. And you do want to see where this money is moving around, because it shows you how bullish or bearish they may be on certain sectors of the economy that they're giving loans to. For the 9 months ended 2019, 2020, you see here they've actually grown their provision for loan losses for multifamily from 170,000 to 192,000. There's no charge-offs, there's no recoveries. Not yet. And so their balance for loan losses for multifamily portfolio went from 653,000 to 845,000. For construction, it went from 96,000 to 1.32 million. And increased 312 to $777,000. So for the 9 months ended, it still shows 0.19 million to 6.76 million in growth. Now, again, if I'm misunderstanding these numbers, please let me know in the comments. I will respond to as much criticism as I can take. Make me better at this. Please do, because I'm self-taught on all of it. Now, you can see here that they break down their specifically evaluated impaired loans. The amount of allowance attributed to specifically evaluated impaired loans has not grown. There's reasons for that. Their total allowance for loan losses, however, has grown precipitously from 6.19 to 6.763. Total gross loans held for investment still being the same as was reported earlier. Impaired loans they show here, and it's easier on the eyes to see. Impaired loans have grown. December 31st. Have grown from 16.26 million to 16.74 million from December 31st, 2019 to September 30th, 2020. So these loans are still showing up as impaired. For some banks, it doesn't. Impaired loans can actually be recorded as receivables now due to Section 4013 of the CARES Act. And banks are getting a little bit of easy leeway for how they can recognize troubled loans. Now, non-accrual and past due loans. Very important, once again, to know about who's being late on their payments and where is it showing up. And this is for September 30th, 2020. They show that discounted has been non-performing loans consist of loans on non-accrual status for which the interest has been discontinued and loans 90 days or more past due are still accruing interest. And their non-accruing loans have actually dropped. They're working with their customers. COVID's allowing a lot of that. But you can see here, the vast majority of their loans are 60 to 89 days past due, but the greater than 89 days past due has dropped a very, very large amount. I imagine this is because they're working with their customers to help them through this difficult time with the economy and so on and so forth. It's them being flexible, I imagine. I could be wrong on that too. If I am, please let me know. But their non-accruing loans have dropped substantially. A total amount of non-accruing loans has dropped substantially from 5.9 million last year to 4.1 million this year, and no loans accruing after 90 days. Troubled debt restructurings. This is a very important section too, because this is where the problem children are when it comes to a bank portfolio. Troubled debt restructuring loans were 1.6 million as of September 30th, and they were 1.8 million in December 31st, 2019. No loans were modified as TDRs during the 3 and 9 month periods ended September 30th, 2020, or during the 3 months ended September 30th, 2019. And they explain here on page 20 the COVID-19 relief modifications. And you can see here Section 4013 of the CARES Act specified that any COVID-related modifications made between March 1st, 2020 and the earlier of December 31st, 2020, or the 60th day after the end of the COVID national emergency declared by the president and the loan was current as of December 31st, 2019, will not become TDRs. So they're shrink wrapping their TDR portion and not adding any more. Banks are doing this everywhere. It is not just Silvergate Capital, but banks are being allowed to hold off on adding loans to their TDR sections, making banks look better. It's not just Silvergate. The company modified 56 loans representing $142.9 million in loan balances, or 19% of total gross loans held for investment. The majority of loans modified under these programs were maintained on accrual status during the deferral period. None of the modified loans met the criteria of a TDR under the CARES Act. As of September 30th, 2020, 17 loans representing $32.7 million in loan balances were still under modification, deferring a portion or all of the contractual payments. So they are keeping a very close eye on this, because the number has dropped from 56 loans during the 9 months to 17 loans, and $142.9 million, or 19% of their total gross loans, dropped to 32.7% and 4.4%, respectively. So you have to keep this in mind when you're looking at banks right now, that they have been allowed by the government to shrink wrap their TDRs. So that section of the balance sheet is not an accurate representation of how banks actually look. And it is okay, because the CARES Act allows that. And this is where they mentioned their credit risk grades for a lot of their loans. And this is what you have to pay attention to. What are the quality of loans that they are giving? Again, very important questions. For December 31st, 2019, you can see here that there are no doubtful accounts, but substandard lending has risen. Went from 7.5 million to 13.5 million. Total gross loans held for investment, You can see here that for commercial, there were no substandard loans in commercial, in their commercial real estate portfolio, but then it jumped to $8.3 million for substandard loans. And it shows, of course, here. That might just be an economic moment with them, and they're working around it by working with their lenders, but their commercial loan segment isn't as healthy as you'd like it to be for a bank. If in their 10K it shows that loans are becoming more into doubtful categories, doubtful credit quality, then you have a problem. And you need to keep that in mind accordingly, that maybe they're not being as strict with their lending as they should be. However, they do seem to be showing a strong discipline with their lending practices, because they're dropping the total amount of TDRs as a percentage of their gross loans. That could be in trouble debt restructuring, as I just mentioned earlier. They're still keeping an eye on their loan portfolio, and that is something that you do want to see. Now, they do mention here related party loans. The company had a related party loan with an outstanding balance of $4.9 million as of 2020. During the 9 months, the company advanced $0.3 million of related party loans and received $60,000 in principal payments. So there is handshaking within the company, within the, executive leadership. That's not a bad thing. There are laws that allow that, but I'm not too familiar on the laws that do allow related party loans, so I'm not good on the details. You'll have to seek better investment wisdom than me. You'll have to seek better knowledge on this one than I have. But it is there, mentioned on page 21. Here they mention their derivative and hedging activities, nothing new, nothing crazy. The cash flow hedge interest rate floor at derivative assets increased from 23 to 34 million for the 9 months ended September 30th. And here they show their risk, their capital ratios. to be well capitalized. They only need this portion, which their total risk-based capital ratio is actually 23.47%, well above the required 10% of capital that they need. So they are very, very well capitalized. And part of the trick about that is, why do they need to be that capitalized? Is because they're doing a lot of loans through their Bitcoin arm, their Silvergate Exchange Network. And I'll jump to that section of the balance sheet. If this will comply. And this will not comply. And here we are. On page 35, page 37, if this will want to behave. They mentioned the number of send transactions, Silvergate Exchange Network transactions for the 3 months and the 9 months ended. You can see here a massive growth in their network from 31.6 million to 140 million number of send transactions, and the dollar volume has increased from 23 million to 76 million. Now, they mentioned here their digital currency customers. On page 36, their customer base has grown rapidly. As of September 30th, they had over 200 prospective digital currency customer leads in various stages of our customer onboarding process and pipeline. And a lot of their customers are digital currency exchanges, including OTC desks, institutional investors that are investing in crypto assets as an asset class, other customers, including new protocols, companies developing new protocols, platforms, and applications. So this is their most successful arm, which I think has garnered them so much attention recently. Now, the SEN is a central element of the operations of their digital currency related customers that enables them to grow their existing customers with their existing customers and attract new ones. And they're one of the ones that I think are being very, very innovative with the new success of crypto investing, which, for the better and all the worse that may be, they're ones that allow a proprietary trading platform for it, and have made themselves pretty successful. I do see this bank getting bought out. I do see them as a takeover target, and that's why I'm kind of curious as to the share price increase so precipitously recently. Is someone buying them out or taking a controlling stake? I imagine so, because they already have a proprietary network to trade crypto assets. But as I've done my best to show, you do have to keep an eye on this bank, because they are still a bank. They still do bread and butter banking. They're not exempt from the current economic headwinds. However, they do seem to be monitoring their credit quality and their loaning practices. They still have substandard commercial grade loans, but they have not gone into the doubtful category yet. You will have to keep an eye on this bank. I will be keeping an eye on this bank. And their 10K will be coming out more than likely in March or late February. And I'll do another video on that as well. I am neither long nor short this stock, and I will not be initiating the position in another 72 hours. Do your own due diligence. This is not advice. It's your money at the end of the day. I'm just trying to help you guys take it a bit more seriously. With these kinds of videos where I open up the 10K, 10Q, and show you what I'm trying to show you, what I've been trying to find about this company. Thanks for watching the video. If you've made it this far, I'll be putting up another video very soon. Thank you for watching. Take care.